Welcome back to Finance in Motion. My name is Adamo, your personal financial planner. And as always, my goal is to help build your wealth and help you sleep well at night. Today's topic is going to be a series of 3 videos on how to help build wealth for your kids. So it's a 3-part series. I will go over the 3 different topics as a strategy that can help you build wealth for your kids. The first video will be talking about how to build wealth through the RESP, the Registered Education Savings Plan. Now, most Canadians know about this plan. However, I'm going to use it in a strategy where it can help build wealth for your kids and for yourself by using some tax-deferred mechanisms that I'll show you in this video. So, as always, my board is full. I will go through each line item one by one. And as always, I set it up as issue, action, and eventually a result, which we'll see later on in the video as I ran out of space. So I'll have to show you the rest in the second part of the video. So the first issue is the question, how do I build wealth for my kids? So I meet a lot of couples that recently became parents and are not sure how to help build wealth for their kids to essentially advance them throughout their lives. So when they're in their 30s, they'll be much more ahead versus where they were at the same age. So the action is to look at the RESP, so Registered Education Savings Plan. I always recommend that you set it up as a family plan. In essence, you don't know if you're going to have more than one kid. Some people do, but it's always better to reserve the right to have it as a family plan. So if you have more than one child, the money available is just essentially a pot, okay? So one child goes to post-secondary education, uses some of the money. If there's money left over, the second child can use it, and so on and so forth, okay? So what is an RESP? Well, it's money for any post-secondary education. So there's some misconception out there that it's only for university. It is not. It's for anything post-secondary. So CEGEP, a trade, university, postgraduate, as long as it's post-secondary, the money can be withdrawn and used to fund the education costs. So how does it work? Every dollar that I contribute, I'm entitled to a 20% federal grant, so 20% free money, and 10% provincial. Based in Quebec here, we have a 10% additional grant from the provincial government. So check in your respective provinces, but the one I always work with in my calculation is the 20% federal grant to show clients over time, and the 10% is like a bonus or gravy, okay? In addition to these grants, so if you think about it, it's 30% free money on every dollar. So every dollar I have that I invest, it's 30 cents on every dollar, no risk, okay? The addition to that is that the money that's invested, your contribution plus the grants, are now invested on a tax-deferred basis. What does that mean? All the money that's invested grows over time until your child needs it for post-secondary education. So if your child is recently born, 16 years more or less until they need that money. So all the growth is on a tax-deferred basis, okay? So one day we will need to pay taxes. I will show you how we can minimize and even in some cases mitigate the taxes on the withdrawals as well. So I put a little example to show you how the contribution phase works in this plan. So 2,500, why did I use that number? I'll show you that this number is actually the maximum amount of annual contribution per child, where you get the maximum federal grant, okay? So the government will not give you more than 20% times 2,500, $500 max per year. So there's no point in putting 3,000 because you will only get a ceiling of $500, which represents 20% times $2,500, okay? This is per child, by the way, okay? And you don't have to put this amount. You could put an amount inferior to that, put what you can. So if you get gifts from family, birthdays, family asks, what should we buy for the child? We know that we always end up having too many toys that pile up. So contribution to education is always a great way to do that. And they can contribute to the investment account by way of direct check or via the parents, okay? So that would equate to a $3,000 annual contribution, including the grants. Again, I'm not including the 10% because it's a bonus. So I'm keeping it general enough to say the 20% federal grant across Canada, how does that grow over time if I contribute over time? So I take that 3,000, I invested for 16 years. Why? Because that's when I start post-secondary education, more or less. If your child is 5 years old, well, subtract that and see how many years left. That doesn't mean that the plan needs to end at that time. It's just that we put the goal as of the time where they start withdrawing the money to help show how the growth occurs. So I put a growth rate of 6%. Now you can play around with these numbers, put 5, 4, 8. Again, it's more of a balanced approach. So long-term 6% on an average rate of return. So that equates to more or less 89,259. So the first reaction that our clients have is, wow, that's a lot. My child will not necessarily need that much for education, especially if they go to school in Montreal, in Canada. So that's the first reaction. However, I would caution clients in thinking about inflation, so the rising cost of education, especially post-secondary education. The rate of increase of tuition is way beyond inflation. Again, it's a business, right? So they charge more and more every year. So we need to at least keep up with inflation and try to keep up with the rate of increase of tuition at the Canadian institutions. So the other thing is that this is a family pot. So if you have 2 kids, well, this money needs to be for the family, both kids or all the kids if you have more than 2, okay? So again, as I mentioned, this excludes the provincial grant. So if you want to play around by adding a 10% extra contribution here for the provincial grant, you can see that this number would be even bigger. So essentially, I hope this helps you understand how the contribution to the RESP works. Again, this money can be from your budget, from family's budget, for events, as I mentioned. So the good little tip as to how to reduce the amount of toys you have and increase the amount of money you'll have for your kids at the withdrawal phase. So this is the contribution phase of the RESP. I'm going to now show you the withdrawal phase once they start post-secondary education, what's needed, how do we withdraw that money in a tax-efficient way so that we can either reduce the taxes or not pay any taxes on that amount of money, and how you can help build your wealth with some of the excesses in the account. So in the withdrawal phase now of the RESP account, so what happens? So we see that we were starting with 89,259, and at 16, or when your child starts post-secondary education, it might be 17 depending on their date of birth, the child starts CEGEP. Post-secondary education, it could be a trade, like I said, but in this case, I put CEGEP. So under the assumptions that I withdraw 5,000. So we don't necessarily have to withdraw 5,000. There is a limit for the first withdrawal of the RESP. So let's assume I withdraw $5,000, and you'll see why I put that number in the example. You could withdraw 1,000. So logically, let's say we take out 5,000 in the situation of the example I'm showing you. So well, the key part about the RESP is that if your child goes to post-secondary education, all we need is to show that your child is signed up for post-secondary education via a letter from the college or the CEGEP, as well as a proof that they're signed up for that semester. So when we withdraw the 5,000, the taxes on that income or that withdrawal, remember, it's made up of 3 things: your contribution, the government grant, and the growth in the market. So that money, when you withdraw the 5,000, it's taxed on your child's head. So based on their total income from that year. And that's the key in this situation. So if your child did not earn any income because they're not working at 16, for example, in terms of the federal income brackets, the income tax brackets, from 0 to 12,300 as of 2020, there is 0 federal income tax. So the key here is if your child has 0 income and you withdraw 5,000, there should not be any income tax on that 5,000, thus a tax-free withdrawal. Okay? So let's continue in the example, and I'll show you how to be even more efficient with that money. Again, the government will not check what you do with this money as long as they're in school. They will not come ask you what that money is for. So we fast forward. So we pay that education for that year. The difference of that money, put in your child's bank account, put in your bank account, do with it what you will. Let's continue. At 18 years old, so 17, 18, we withdraw every year. At 18, we withdraw another 5,000 as an example. Okay, could be less, could be another amount, but let's say 5,000. And now your child has a part-time job earning 5,000 income for the year. So it could be more, it could be less. It's just an example to show you how the mechanism works, okay? So school costs, I assume that they're $2,000 for the year. Okay, it could be more, it could be less. Again, it's the example. So remember that the $5,000 that I pull out will be tax-free, essentially, because if they're here, even if they earn $5,000 and I take out another $5,000, I'm still within the 0 to 12,300 federal income tax bracket at 0%. So there's still no taxes on the withdrawal. Now, you pay the school cost of $2,000, and now I have $3,000 difference. Here's where we can start doing some tax-efficient investing. Why? Because at 18, your child can open a tax-free savings account. Okay? So what is a tax-free again? I have a video that explains the tax-free versus RSP. So check that out on the channel. But again, a short recap. Any money I invest in a tax-free savings account, the growth is tax-free, and the withdrawals will also be tax-free whenever I withdraw. The max I can contribute per year is $6,000 per year. Okay, there is a cumulative max, but just keep the $6,000 per year in mind. And the child must be 18. That's why I didn't do it at this phase. Okay? So, child is 18. Now we have a difference from, I withdrew $5,000. My school cost was $2,000. So I have $3,000 difference that I could do something with that money. So I'll open the tax-free savings account. I'll contribute $3,000. And in my example, I just said, I'll do this for 5 years. But again, you could do it for longer. You have other kids. And remember, we started with a balance of $89,000. So we can do this for a prolonged period of time. There is a max date at which the RDSP must be closed. So, but for the case of this example, let's just assume we do it for 5 years. So $3,000 contributed 5 years, so annually at 6%. That would give you more or less $18,000 of accumulated value. So you see that not only did all my contributions way back when my child was first born were tax deferred, I got federal grants, provincial grants, which make this number higher if you remember. The money was invested in the markets, which also grew tax deferred. And now I'm withdrawing in the withdrawal phase at a tax-free way because of the, not to forget the income tax bracket. And also, I'm then taking that difference and investing it in a vehicle that's also tax-free for the future. So the gains are tax-free and the eventual withdrawals will be tax-free. So once your child starts his or her full-time job, this account will already have been open and there'll already be a decent amount in there. And when they hit 25, 30, 35 years old, they can use part of this money as a down payment on their first home, for example. So you can see how this strategy is very, very interesting on the idea of building wealth for your kids in the future. Okay? So the result of this is essentially that you're taking that $2,500 contribution when your child is born, investing it in a tax-deferred mechanism for school, so their education will be taken care of, and then any difference of money that's there will then can be invested in a tax-free. You don't have to, but this is a really tax-efficient way of investing that difference. Okay. Finally, I'd like to add that if we get to the point where both kids went to university, they finished their education, and there's still a balance from this amount. Okay. So say example, there's $20,000 left in this account. So a lot of people will ask me, Adamo, what do I do with this money? So we can make sure in the withdrawal phase that we're redeeming as much as possible to not pay taxes, and we have to look at is that going to equal where this goes down to zero before I need to shut the account. Okay. Let's assume that there is a balance. We were not able to redeem enough money based on the income of the child. So again, if the income of the child is at this point, well, any amount above it will run into some income tax situation. It's okay to pay some taxes on those gains, but if we can avoid it, why not? But let's assume there's $20,000 left. Well, we can essentially contribute this or transfer it to your RRSP of the parents. So we can transfer that amount to the parents' RRSP, provided your federal notice of assessment. There's a little box that talks about the available room in the RRSP. You have to make sure that you have that available room. We could transfer that tax-free into your RRSP for your own retirement. And again, that allows you to avoid paying taxes on these gains. And then you'll pay the taxes on your withdrawals once your RRSP converts to a RIF, which is the RRSP converting to the account where you need to redeem that money, which is in retirement, and at 71 where you have no choice. But the idea is that if we can defer taxation, it's always better to defer taxation because the money will keep growing. So this is a nice little trick at the end that we can do if there's a balance in the RESP account. So I hope this helped you understand phase 1 of the 3-part series on how to build wealth for your kids. Again, as always, if you like the video, please like it and subscribe to the page at the bottom. And as always, have a great day.